My name is Mark Lyons. I'm the Director of Sales at SMS Financial Solutions, and this is our monthly life webinar. We have two special guests today. We have Shannon Keller, who's the AVP and Assistant Chief Underwriter at Columbus Life, and we have Jeff Tabor, our Regional Vice President, responsible for calling on our office and helping all the agents that do business with us. So welcome, Shannon, and welcome, Jeff.
Thanks, Mark.
We're very, very happy to have you here today. Shannon is going to talk about underwriting, and she's not only going to talk about it from a medical perspective, but also a financial perspective. And I think it's very helpful for agents and advisors to understand that process better. Sometimes I think agents and advisors get a little nervous if they've had a life insurance case that goes the wrong way because something came up in the underwriting process. Sometimes it's a situation where, they getting asked questions and they don't understand why they're being asked these questions or why the client is being asked these questions. And it just kind of feels like they're just trying to trick you or trap you. And so I think Shannon's going to dispel a lot of those myths, make it in plain speak of what the insurance carriers are looking for, and to help you get more cases through the process, and get paid quicker and sooner, and make sure the clients get the coverage they desperately need. So with that, Jeff, I think you might go off camera, and I'm going to stay with you. Jeff's going to come back later. But I think Shannon is going to go through her presentation, and I might interrupt occasionally just to ask a question or to clarify something. So take it away, Shannon.
All right. Thanks, Mark. All right. As I said, my name's Shannon Keller with Columbus Life. So I'm excited to share navigating the underwriting process with you. In this presentation, we're going to look at what exactly is underwriting. Myth versus fact. We'll go through some of the underwriting process. And as Mark mentioned, we're going to look at both the medical and the financial risks that come along in life insurance. We'll also talk a little bit about reinsurance and some of the underwriter decisions, how they're made. And throughout the process, we'll also include some frequently asked questions.
Okay. Hey, Shannon, just before you get too deep into it, I just wanted to let the audience know that this is a pre-recorded webinar. Sometimes we do them live. Sometimes we have to pre-record them. So you won't be able to ask any questions. If you do have questions, though, feel free to reach out to me, reach out to your marketer, contact SMS directly if you're not already contracted with us. And we'll get those questions answered, and we'll help you through the process. But right now, the chat function and the Q&A functions will not be operable.
Sounds good. All right. So what exactly is underwriting? Underwriting is the process of assessing the level of risk presented to an insurer in order to determine the appropriate premium that a client's going to pay. Life insurance underwriters specifically, as we mentioned, assess financial and medical risk. So some myth versus fact. I hear all the time that underwriters are paid to decline applications. Really, that could not be further from the truth. If we're not issuing business, we don't have a job. Declining business is absolutely easy. If an underwriter is putting the effort into a case and asking you questions, they are trying to get to issue for you. Not looking to decline. We like our jobs. Underwriting requires little training. It's simply following what's out of a manual. While that is true, we do use an underwriting manual. It is more of a set of guidelines, and we look at the small details within the applicants. If maybe somebody has depression, are they employed regularly? Are they having complications with it? So we do like to dig down to the details to make sure that we are assessing appropriately.
And I can assure you that they have a lot of training. I mean,
Oh
it's
yeah,
a lot of training because we've some companies have made the training available to us,
Oh, nice.
and I'm like, okay, well that's a lot of time to
It is.
devote to something. So
It really is.
yes, there's a lot of training.
And just for fun, other myth was that underwriters are just generally unhappy people. This came from an agent that had visited me years ago in this. And, after we had lunch together and he's leaving, he shakes my hand and says, "Wow, you're really nice." And I said, "Thank you." And he just said he thought that all underwriters were unhappy people that sit in the basements and decline applications. We couldn't be further from the truth. So the underwriting process, getting into that, there is application completion, which you as the agent would take care of. When that comes in, it's being reviewed by our new business department. Then it goes to underwriting. Underwriting is going to set the requirements based on age and face amount, and also based on any medical conditions that were disclosed on the app. Underwriting decision you'll get once we have gone through all of the requirements. And then lastly, reinsurance. Reinsurance comes into play if we're not able to make an offer at all. And sometimes if we have a substandard offer and you need to get that offer improved to place, we partner closely with our reinsurers to help us stretch some of those decisions. So the application completion process. The client and the agent should fill this out together, completing all sections of the application. It's going to contain details such as personal demographics. We're going to look at occupation, their finances, lifestyle. Do they have, any hazardous hobbies? Do they skydive, scuba dive? Again, we'll look at their medical history. And honest disclosure by the agent is the key. Underwriters are always suspicious. It's just in our nature of what we do. Once we have caught, a client not disclosing something, it's hard to get that trust back from the underwriter. But if everything is admitted up front, a lot of times we'll feel a little bit more comfortable, that you are giving us, quality information and we can make a decision off of that.
Yes, and I think, and I know that happens. Definitely worked on cases where there was not full disclosure, and more than often than not, I think the agent or the advisor just didn't know and didn't ask a lot of the questions, and then the client sometimes innocently just thinks it's not important, right? So they don't disclose either, but sometimes it's people trying to pull the wool over their eyes.
So as we get into the underwriting process, the underwriter is going to set requirements. So again, based on the client's age, amount applied for, and the risk factors, we're going to select which requirements are needed. Typically, the common requirements you're going to see are listed here: MIB, the paramedical exams, labs, EKGs, pharmacy, the APSs, which are attending physician statements or our medical records. Some of the less common requirements, these are typically what you'll see on higher dollar cases, or in an event that we're trying to not have to get an APS. So inspection reports, those typically are gathering some financial history as well as criminal history for us. Third-party verified financials. When we talk about that, we're asking for tax returns, if justification is coming more from their net worth and not their income. We look at current balance sheets, CPA prepared financials to get that justification. Our telephone interview, that is a requirement. If you see that, the underwriter's trying everything to not get an APS. As much as you don't like waiting for them, we don't like reading them. So we will often work pretty hard to see if we can get around having to order those. So I mentioned MIB. In that last one, that is the Medical Information Bureau. It's an insurance consumer reporting agency. I usually describe it as being similar to a credit file, but for insurance. So client goes into company A, they admit that they're a smoker. So they get through the underwriting process, they're given tobacco rates, and there's a code that gets put out that indicates they admitted to smoking. They come to company B because they didn't like that smoker rate. They don't disclose it to company B, but we get these codes, the MIB, and those come back to us every time an application is submitted. And so it really helps prevent a lot of fraud that goes on. An MIB is owned by all of its life insurance members. You have to be a member to be able to report and get codes. And that encompasses probably about 90% of all US life insurers. So the pharmacy database record. This is another newer requirement in recent years. With all of the electronic records available, we are getting more and more information. The pharmacy data we get uses some claims data, so billing data from the physicians. We also look at any kind of diagnosis codes, ICD-9, ICD-10 that they have out there. Insurers get a listing of all the prescribed medications that a client is on. We can see the doctor that prescribed it and often that specialty. So that really helps us if we see somebody's on a high blood pressure medication, and most of those do double duty for high blood pressure and cardiovascular disease. So if we see that maybe being prescribed by a cardiologist versus their PCP, that'll raise red flags and helps the underwriter know where they need to go in their process. So what is it that we're going to assess? Health history. We're going to look at your lifestyle, the occupation, smoking, finances, and family history. So smoker rates, use of any tobacco containing product or nicotine containing product in the last 12 months. So that's whether it is smoked, vaped, patches, gum, any nicotine delivery system. To get a non-smoker rate, clients have to be nicotine free for at least 12 months to qualify for non-tobacco rates. Most companies will also have maybe a 2-year period before they'd be eligible for preferred non-tobacco. So medical underwriting. What exactly are we doing when we're assessing the client's health? We're looking at their past and their current health impairments, and we're looking at what is the risk of future health problems. We do this to mitigate the financial risk to the company, assuring the company is able to honor all of our obligations at claim time. If an underwriter inappropriately assesses somebody's mortality, the premiums then that we're charging are going to be too high, too low, and then there's financial risk to us as the insuring company. Quoting too low, we risk losing the money on premiums that should have been higher because we're likely to experience an early claim. And quoting too high, we just lose business to competitors. So it is a balancing act that we walk when we are trying to make those assessments. Okay, so the health history, chronic conditions, major illnesses, we're going to look at. When we're looking at those, we're wanting to see, is the client having regular follow-up as they're advised? Are they compliant with their treatments, medications, and things of that nature? We'll also look at family history. Underwriters are going to look at natural parents and siblings when considering that. Commonly seen hereditary conditions that may negatively affect somebody's assessment would be someone who has parents who've had cardiovascular disease prior to age 60, colon cancer, breast cancer, and the younger the ages that the parents develop, the higher that risk is for the child that we're underwriting.
And I will say, I mean, this is for kind of more SMS, if particularly with tobacco and family history, if you as an agent or advisor are aware of a client that has either one of those situations, go ahead and reach out to us because carriers are a little bit different in how they look at some of that stuff. and, we can probably point you in the right direction with regard to those two situations.
All right. So next in the medical underwriting is clinical versus insurance medicine. This is something that we find ourselves as underwriters explaining quite a bit. Somebody had a heart attack. They go in to see their doctor. Well, they go to the hospital, they're treated, and they're following up with their doctor. And doctor says, you are fine. You are doing fantastic and great. Then they apply for insurance and they're not quite sure why we're rating them. And the difference really comes in the fact that the doctor they have the time to watch and wait. So they don't have to be correct on that first guess. If they say, let's observe, what's going on, and a month later, the client starts having significant symptoms, the doctor's got the option to change course, change treatment plans, and correct where they were headed. Whereas for life insurance, we have one opportunity to get it right, and we have to factor in what future outcome is most likely to happen. So while somebody might be doing great for somebody who had a heart attack, in the grand scheme of things and in comparison to, a healthy individual the same age that has not had a heart attack, the mortality, there is a good difference there. Clinical medicine, as I mentioned, the doctors have that luxury. They can say, let's watch and wait. We see this a lot with prostate cancer, and that's becoming increasingly. So because it is a fairly non-aggressive cancer, it typically grows pretty slow. And so depending on the applicant's age, doctors are really into just, let's see how this progresses before we put you through, surgery, chemo, radiations, and things of that nature. But again, with insurance, we just don't have that option. A lot of those, if they were left untreated, would result in early mortality. And unlike the doctor being able to change courses, we're not able to change our assessment after issue. So just some reasons why, you may have an underwriter asking, some more in-depth questions.
Yeah, we hear a lot about advisors coming back to me and the team and saying, "Oh, the insured says he was fine." That's what their doctor said. So
yes,
yeah,
that's about always how it goes.
Yeah, it does a lot.
So here you see we've got the clinical versus insurance medicine. I have a case study here. This was a male in his 50s, had elevated PSA, free PSA readings, and we postponed the case. Doctor told the client, hey, we're just going to watch what's going on. He had an elevated PSA that wasn't terribly elevated, but slightly so for his age. He comes back to underwriting and says, hey, I am great. I saw my doctor. We don't have to do anything. Because of the test, we were still quite concerned. While his normal PSA was okay, the free PSA had increased quite a bit in the last year. And that is often a high indicator of prostate cancer. We gave those details to that client. He went back to his doctor, forced some additional testing, and confirmed that he actually did have prostate cancer and was in the early stages of it. So you can see how, us playing on that whole insurance medicine really helps us out. And in that case, it was a great outcome for the client. I can say that after a year, he did come back and was issued a policy with us. All right, now we're going to switch gears. We're going to talk about financial underwriting. It is the evaluation of a proposed insured's personal, business, financial background and current financial situation. This is important to underwriting so that we, one, prevent overinsurance, also to prevent the client from not being able to afford or making them worth more dead than alive. I know a lot of people, when we bring that up, they're like, that's only on TV. They don't see that. I I can tell you that it actually is a real concern, and it is something that, at claim time, we see, probably a couple times a year. So what we're looking for when we're doing financial underwriting, we're looking for insurable interest. Does the beneficiary stand to have a financial loss when the insured dies? Affordability, we look at, can they afford the premium that they're applying for? Most insurers will typically allow about 20% of a person's income to go into the policy. Income replacement, we're looking at the amount of death benefit allowed on a client based on their age and their current annual income. So for example, a 35-year-old would usually qualify for up to 25 times their income. And then finally, it's for estate protection. That death benefit will go in, and that will essentially cover the estate taxes, making that a wash. General financial underwriting guidelines, these can certainly vary based on carrier, but working adults, usually you get an annual income multiplier, like on the previous screen where we had a 30-something-year-old who was going to 25 times his income. Juveniles, we will typically allow about 50% of the parent's coverage, up to $2 million. When you start getting over $1 million on kids, the underwriters are going to ask a little more questions. Not that cannot be done. They are all just individual consideration. Each of those situations, we want to look at it individually. A non-working spouse, so we will allow them to have 100% of the working spouse's coverage, again, up to $1 million. For over $1 million, we allow half of what the working spouse has. Key person, 10 times salary. We'll also consider bonuses that are given. And buy, sell, business value, just multiplied by the percent of ownership when we're looking at that. Our acceptable forms of financial verification, you'll see there, tax returns, W-2s, accountant statement, balance sheets, anything like the balance sheet or a profit loss, if we're looking at business financials, do need to be signed off on by a CPA. So here's an example. We have a married couple in their 40s, each applying for $10 million. Their household income is $120,000 to $160,000, and they're telling us that their net worth is $2 million. So they're stalling to provide third-party verification.
20 million, right?
Excuse me?
Not 2 million, 20 million.
Oh, 20 million, yes. Yep. Sorry about that. So what resources do we have at this point if we're not getting that? Underwriters will use Google. High net worth individuals, we find there's almost always information out there online. We'll do an address property search. Does their home fit, the income that they're giving us? And social media. We will get on there to see, are there lifestyle factors that haven't been disclosed? It is important to note, though, that the resources are not true verification. Underwriters will use those to guide them in their actual investigation. If we were looking at somebody's social media and perhaps there was something that made us worried about maybe some criminal activity, the underwriter cannot take action based on that, but they would then go and order a criminal history report on the client. Often the lines of questioning, when we have clients who are trying to mislead us in their finances, they usually end up providing conflicting information, or we'll find that once we start pushing really hard, they'll withdraw those applications. It's been my experience that most folks who are applying for policies of that size, they usually can give you something from the outset. When they're giving absolutely nothing at all is when you'll find an underwriter starting to dig a little deeper, perhaps ask more questions, and ordering more reports.
Is that why we ask questions more than once sometimes too?
Yes.
Okay.
Yeah. And I know that's frustrating. Sometimes the question isn't initially answered, what the underwriter was looking for. That happens quite a bit, or if they've got a two-part and only one part was answered, and they'll go back and forth sometimes there. Some of our other underwriting factors, occupation, sports, and hobbies all carry an increased risk depending upon what somebody's into. Examples of some of the hazardous occupations and hobbies that we typically see: law enforcement. Now, your typical, beat cop working in a municipality is not going to be rated, but you get somebody who is SWAT, bomb squad, things like that, could definitely raise that rate. Firefighters, typically there's a small rating on there, and it depends on, where are they working? Are they handling more residential? Is this somebody who, maybe is in an area, trying to fight where we've got a lot of the wildfires going on, which would be more risky. And then scuba diving, mountaineering, pretty common things. Participation, in any of these does not mean an automatic decline. What you'll typically see is a flat extra rating. Usually, presented as, for an example, $5 for every $1,000 of coverage applied for. And then in the future, if that hobby or the occupation is done, they can come back and apply for an improved rate. So exclusions, that is another option that you have. A lot of companies will offer what they consider to be exclusion riders for certain hobbies. So if you've got somebody who is a rock climber, does a lot of mountaineering, we would add in, a statement into the policy, that a clause that would essentially say, if he died during the climbing, we would not cover that benefit. So some other factors that we'll look at: alcohol use. We're curious as to, how often, how amount, an amount per sitting. What we're really trying to find is, looking for those folks who have an actual alcohol problem. Coming home and having a glass of wine at night, having a beer is not an issue. We're really looking for the people who come back, and maybe it's a 6-pack a night, or a bottle of wine a night. That's where we get more concerned. Illegal drug use. We need date, last use, any treatment, any relapses. Typically about the 3-year mark, most insurers will start to offer coverage again. Typically, you're going to see that as a substandard rating, probably until they're 6 or more years sober.
I've got to ask a question about the illegal drug use. So have you ever seen a situation where a lab result was wrong that tested for drugs?
Never.
Okay.
And we hear a lot, sometimes, secondhand smoke, which really isn't a valid reason for that. We do set our testing limits are a little higher than some clinical limits, and it's to kind of weed that kind of stuff out. Because you would have in the past bartenders and maybe wait staff who worked in a smoky business and could have trace amounts of that codeine showing up. But for probably about the last 10 years or so, the life insurers have increased that threshold. So those do not affect us. Underwriting decisions. So we range from preferred through standard through substandard. So you'll get in preferred classes, you're typically looking at about 2 to 3 different classes. For Columbus Life, it's super preferred and preferred. On our term plans, there's also a preferred plus that's available. Standard, it's tobacco, non-tobacco, and then you get into your substandard ratings. If a decline is going to happen, that means that no coverage is going to be issued. A letter will go to the client explaining that decision. And the postpone, also no offers are made. But you should be getting information on there saying, you know, when X happens or after, you know, so many years have passed, we'll be able to reconsider that client. And a lot of times you'll also see that, you know, maybe they're scheduled to have a stress test done. We'll ask to postpone that application until they've completed that stress test. And that goes back to clinical versus insurance medicine. Because if that stress test comes back, you know, that there are complications and we've already issued the policy, we can't go back and change that decision. So some frequently asked questions that we see a lot. Do underwriters set the premiums for each policy? We do not. Each class has a predetermined premium rate that's already there. We are just assigning folks to those rate classes. But the underwriters typically never see what that actual premium turns out to be. And so this means that, you know, you could have two people of the same age applying for the same product and riders, and placed into the same, they'll be placed into the same rate class and pay the same premium. So I know you probably hear a lot about reinsurance. Typically, if you've had a tough case that you're looking at some substandard, maybe it's, you know, leaning towards a decline, and the underwriter's reaching out saying, hey, here's some of our options. And one of those is, you know, with our reinsurance partners. So reinsurers are insurance companies for the insurance companies. So for example, you know, we get $1 million case, we will keep 10% of that here, and the other 90% is automatically ceded to the reinsurers. They also work with us on case-by-case basis for full facultative, where they would take the entire policy. In those situations, we send the file to them. They do a full review with their underwriters and then give a decision to us to say, you know, are they going to help take on some of that risk? When they do that, that allows us to have a little more bandwidth with what we're offering. We're not quite as pigeonholed into just our own guidelines. Once we get those reinsurers in, they have big data, a lot more than the typical carrier does. And so they can often make much more favorable decisions.
Could you talk a little bit about, you know, I think we've all seen situations where the BGA or the IMO or the agent advisor would like the insurance company to stretch on a case,
Yes.
just to make it a little bit better rating,
Yeah.
to get a little bit better price. And, you know, you almost kind of touched on it, what the risk is here, as it pertains to reinsurance.
Yeah. Some companies will use reinsurance automatically. At Columbus Life, we only do that with the agent's permission. The reason we do that is if we take that entire case and submit it facultatively for them to review. Remember, I said we're giving them, you know, 90% of some of this business. So they're going to make a decision. If it comes back less favorable than ours, our decision's done. Because we're ceding to these companies, we've given them the opportunity. They're saying it's worse, and we can't go back and change that. So my advice has always been, you know, if you cannot place it at all with the rate class that you got, you have nothing to lose. Let's go for it. If you can place it, you know, have that conversation with the underwriter before, you know, you consider doing that. In a lot of cases, they can work with you and give you an idea of, hey, I think this is a good candidate that a reinsurer is going to improve the decision on, you know, or hey, this one's probably not going to go anywhere. Or if we do, I feel we're at risk of, you know, downgrading our decision that we already put out there.
So the reinsurer is really, in essence, sharing the risk with the insurance carrier, they have rules that they've determined in looking at cases that they've decided between the two of them by like a treaty. And if the primary carrier, like Columbus Life, rates a case outside of those parameters, so they give it a better rating than they should have based on the rules, then the reinsurer can decline to pay their share of the case if the insured dies. And I think that's the risk, right?
Absolutely.
Yeah.
Yeah, they just like, we audit our underwriters, our reinsurers come in and they audit us every so many years, just to make sure that we're following the guidelines that we told them we would follow. So when we talk about the reinsurance, there's really two different kinds. The automatic, that's pretty much what I had previously described, where we're not sending the file to them, but they're automatically taking a percentage of the risk for all cases that we issue. The facultative, that is the one where their decision is the final say. If we send it to them and we're, table B and they come back table D, we're stuck with that higher rating. Another thing to think of is if you've got a client who has been submitted facultatively, if they come back to the same company for coverage in the future, all future cases must go back facultatively. So we do lose some of that autonomy in the decision making once we've involved them to that degree. So typically the basic setup of how it works is the internal retention. So that's the amount of risk that the carrier is going to maintain after it's issued. And the automatic binding limit, that is the amount of coverage that we can underwrite, put it on the reinsurer's books, but they don't ever have to look at it. They're trusting us that we're following our guidelines, doing everything we said we would do. And in doing that, they let us bind them. For Columbus, it is up to 20 million. That number is different, carrier to carrier. All right, so hot topics. Marijuana. I don't think I've ever done any kind of presentation or Q&A where this does not come up. I am really happy to say we have increased our ability to take on marijuana users. Previously, until a few months ago, all of our marijuana users were standard tobacco across the board. The industry did start in that spot, although most folks have now gone to non-tobacco rates. When they're underwriting it, we view it really similarly to alcohol. My concern when I'm looking at somebody who uses marijuana, it isn't so much that the use in and of itself is an issue, but like alcohol, is it being abused? The thing that you hear a lot of underwriters, are they wake and bakers? Does somebody have to get out of bed and get their day started? So those are really what we're more concerned about. Driving it. Are they smoking it and driving? Getting into issues there when we look at the MVR. But I only expect the industry to get more and more lenient as it becomes legalized in more states. I will say, in connection with the marijuana, should you have people who insureds who are dispensary owners work in the marijuana industry at all, we still are not able to take those cases. And we probably won't be able to accept those until it becomes federally legal. There are some banks that are starting to do business with them, but it is still pretty minimal.
Yeah, and again, if you've got cases that involve dispensary owners, come talk to us. I mean, there's been a little movement by, I don't know, a carrier or two, and we can direct you in the right direction for that.
Yeah.
But most carriers are the same as Columbus Life and how they look at it, just because it's still federally illegal.
Yeah, when it comes to those who work in the industry, that we just haven't seen much shift in that. I think we will. It's slow, but I think we'll get there. So moving on, genetics. This has been another, just big topic over the last few years in underwriting. While there's been legislation protecting consumers applying for health insurance since 2008 under GINA, that law does not apply to life insurance companies, at least not yet. So the reality is that most of the life insurers, we're not trying to obtain, direct consumer genetic testing like the 23andMe. I forget what some of the others are, but what we're looking for is testing done by a physician. A great example of that is the BRCA gene used to determine the risk of breast cancer. An underwriter can use that with a couple states that are exceptions at this point to assess the case. We do anticipate that over the coming years, life insurance is going to skew more towards the health insurance, where using a lot of this genetic data is just going to not be possible.
What if someone wanted to provide genetic data that they think that would help their case?
We would definitely take that. And because the client's supplying that to us on their own accord, we could take that and look at it. We would not, though, be able to take adverse action on it. But if it's something that will help get it issued, absolutely. So next are the wearables. We've been hearing a lot about companies looking into, offering reduced premiums for people that, wearing their Fitbit, or a lot of the Apple Watches, Samsung watches that people are wearing now. Some companies are actually offering discounts who complete, maybe 10 hours of activity over, a set amount of time. The drawbacks, though, is that one, you can't really, know who is wearing that wearable. Our joke has always been, stick it to your dog's collar, let them run around all day, and you are going to look fantastic. But I mean, the reality is they're very hard to verify. I don't see them becoming as used as maybe we thought they were going to be a year or two ago. Now, accelerated underwriting. This has been popping up since 2020. Just about every life insurance, company got just thrust into figuring out how to do business outside of the office. Because of that, a lot of accelerated underwriting came in. We didn't have examiners that could go out and do the exams. We had to get creative. So the accelerated underwriting programs really allow the best risks to go through without having to get fluids. Most insurers, Columbus included, will use a predictive analytics score. It's not a credit score, but it uses credit attributes to make that score. So behind the scenes, it's looking at, does your client have a history of bankruptcy? Are there any liens or judgments in their history? Overdue accounts, things of that nature. Those who get a passing score, they will go through some minor underwriting. We do non-invasive requirements first. So if we've got somebody, their score is going to pass them through initially. We then go into just a pharmacy, motor vehicle report, we pull MIB, and then a database report. And if all of those are clear, we never touch the client. They get to go through fluidless, and this is a pretty common, use across the industry. I don't know that there's a company out there that's not utilizing at least one version of accelerated underwriting. I actually, it's going to keep increasing. In the time since I first did this presentation to now, I mean, accelerated underwriting has just exploded. And with the AI now coming out, you'll see a lot more options from underwriting. I think it's going to be really, really good for us. So electronic health records, these have we've been hearing about them for quite some time now, but only recently are we really getting usable information from them. As these, the electronic health data stores, something like Epic, Cerner, they are getting more and more facilities using their services, which means we are getting records much more quickly when the electronic are available. So typically, a traditional set of records will take maybe 15 to 20 days and sometimes more. If you've had to ever deal with Kaiser or the VA, I can remember times when, those Kaisers would take 4 months or more to get those in. They are now on one of the electronic platforms. And so we can now get records from them in about 5 days. And that just seems to be increasing across the industry, where more and more physicians are now, especially if they're working within a health network, that there's a level of electronic records that get used.
What would you say the percentage is of insurers that come through that do not have an electronic health record available? Or in the inverse, how many insureds, what's the percentage of insurers that do have electronic health records available?
So it's kind of a two-part. We will get a hit on probably 75 to 80% of all the cases. But what happens is it's often not what we were looking for. So maybe we were looking for cardiology records. We order the EHR and you just get everything under the sun, but no cardiology. And so that can sometimes, cause some issue there. But that's it. If we take those out, maybe about 30 to 40% right now, where we get usable information. With the way that it works, we are using it more as a tool for an applicant that we don't believe is sick. Those age amount, that healthy client that just has an app and APS for the age and amount. If we order those and we don't see anything significant, we're good to move on. In somebody who has significant history, we're a lot more likely to get those hard copy records unless we know for certain that they're available on the electronic database. So yeah, some of our new data sources and underwriting that have just been gaining steam, clinical laboratory results. So we now have access to about, here it says 70%. I believe that's actually higher now, closer to 80% of all US lab testing we are able to obtain. That is fantastic. I don't know how many times, we've had somebody, maybe they've got a history of anemia and the underwriter just wants to see, that last set of labs that they had done with their doctor just to see that it's under control. We can go out, order this data, and it will return the lab results. As long as it was done in a Quest lab, Lab 1, which encompasses about 90% of the lab testing labs in the US. I've not had an issue getting any of that yet, but that has really improved the time it's taking to get through those. Health claims data, we're not seeing as much of this. We do have a few vendors who are starting to put that in there. The trick with that is, though, what we've found is a lot of physicians are coding inaccurately, but to get insurance to pay. Probably the biggest thing I see is they're doing lab testing just to screen. They put in, a diagnosis of a cancer diagnosis, for example. The client didn't have cancer. They were just doing a screening to rule that out. So, we have to take that with a grain of salt with how it comes and still, do our own investigation on these cases. And then the kiosk health networks, I have not seen these really pop up like we thought they would, but they were going to be standalone kiosks that, the clients could go to get all the biometrics taken without having to go to a doctor or invite anybody to their home. So that wraps up the main portion of the presentation. Mark, I will turn that back over to you.
All right. Thank you, Shannon. That was great. So a couple of takeaways I had is, this whole concept of insurance versus clinical medicine. And you got, even though the doctor tells the client they're fine or they're good, there's still going to be an issue probably with the underwriting process. And so you always want to get insurance as early as you possibly can before anything kind of creeps up. From a financial underwriting perspective, I think you kind of boil it down to the case has to make sense. If the insured were to die, somebody's got to be out something, and the better that the agent or advisor can describe what they're out, if that they happen to die, the better for the case and getting through the process. And then I did learn about wake and bake, so that's good too.
Got to interject a little bit.
All right, and Jeff's back.
Jeff, I think you're muted.
Thought I would remember that, but I didn't. All right, we're back.
I do it all the
Hey,
time.
Thanks to Mark and SMS for having us on. We really appreciate it. Shannon knows this because she's heard me say it in a number of settings, but our secret weapon is Shannon and her team. Underwriting oftentimes can be the black box that people misunderstand. The one thing about Shannon's team is, one, you got a sense of it today. They're very knowledgeable, but they're very accessible as well. There are 3 different ways you can get information into underwriting and get information back. A quick email, hey, I've got a guy, blah, blah, blah. 2, send records. 3, you can get on the phone with these folks. And it's particularly helpful when you get that offer back and the classic is, I got standard instead of preferred wine. The underwriters can do the agent a world of good by helping give them confidence that, no, they're really not preferred. The doctor said they're fine, but they're not. So I encourage you to reach out to your SMS team. They know how to access underwriting. Reach out to myself or Jennifer. We can get you in touch with these folks. But this is a great resource and a wealth of information. I'll just do a very quick commercial on Columbus, because you've heard a lot of good information, but it comes back to, well, who's Columbus if you haven't heard, and why do I want to do business with them? The elevator pitch that I give is, we're a 95 Comdex mutual company with a top tier IUL with very strong compensation. And that's the quick who we are. The why is that important component to me, having done this for years and years, and Mark can attest to this too. There are a lot of companies that we used to do business with that are not around anymore. And the thing that we're doing is we're helping clients solve problems that are typically long-term problems. Well, long-term means more than a few months, more than a few years. We're talking, 5, 10, 15, 20, 30 years. There's been a lot of change in the industry in that period of time, and there's going to be more coming. We've been around since the 1800s. We've been through all the pandemics and wars and all this stuff. We've got a very long sort of perspective, financially, fiscally. That's where the rubber hits the road, because we've heard large companies get gobbled up and highly rated companies disappear. So I get that. The missing link is how the company is managed and how it's run. We're very conservative in our approach and our thinking and the way we develop. But where that benefits the client is when we put an illustration together, we're not trying to overpromise to get your sale and then underdeliver. We kind of come at it the opposite way, which is counterintuitive in the sales world, is we underpromise and overdeliver. So in that respect, our illustrations are sound and solid. Our product design is clear, and understandable. We don't have a lot of non-guaranteed components in our product that drive a great illustration, but later we're going to change. So from that perspective, it's a company that I think may be familiar to you because you may have encountered someone like this back in the 80s and 90s. That's kind of what Columbus reminds me of, the old school company that's sort of thinking long term. So with that, again, I want to thank Mark and the SMS team. I'm looking forward to coming up to Nebraska soon and mix and mingle with the crew. But let us hear from you. Let us know how we can help you. And Mark, thanks again for reaching out.
Absolutely. Thank you to you, Jeff, and thank you to Shannon. When you would describe the who of Columbus Life, I was immediately thinking that's the why too. So, you can't beat the 95 Comdex, the mutual company, the top tier IUL, and the great compensation. I mean, and I will say that, we appreciate all that you guys have done for us. You're really good partners, and I've always felt very comfortable with Columbus Life. Because I think you don't do things that are not in the best interest of your clients or your insureds, and not every carrier can say that. So, all right. Well, thank you very much. We'll be around next month for another webinar for life insurance. And thank you to everyone. If you have any questions, please reach out to your SMS marketer or reach out to me directly, or give us a ring or drop us a line. We're here to help. All right. Thank you, everyone.
Thanks, everybody. Thanks, Mark.